Legal and regulatory considerations. Fixed income securities are subject to different legal and regulatory requirements depending on where they are issued and traded. You need to understand the concept of a national bond market. The national bond market is the bond market in a particular country. Let's say we are concerned about the United States. Broadly speaking, in the United States, we will have either domestic bonds or foreign bonds. Domestic bonds are bonds which have been issued by American companies, and these bonds are traded in America. If Ford Motor Company issues a bond and that bond is traded in America, then this would classify as a domestic bond. On the other hand, if Toyota Motor Company issues bonds in America and these bonds are traded in America, then that would be a foreign bond. So foreign bonds are also part of the national bond market. Next, we come to the Euro bond market. You can think of the Euro bond market as the global or the international market for bonds. Generally, Euro bonds can be denominated in different currencies. The typical currencies would be the dollar or the euro or maybe even the yen. A few points to keep in mind. The Eurobond market is generally less regulated than the national bond market. Eurobonds are typically underwritten by an international syndicate. An international syndicate is a group of financial institutions from different jurisdictions. You also need to understand the distinction between bearer bonds and registered bonds. With a bearer bond, the trustee does not keep a record of who owns the bond. That information is only with the clearing system. On the other hand, with registered bonds, the trustee does keep track of who owns which bond. Generally speaking, Euro bonds or bonds traded in the international market or global market tend to be bearer bonds, whereas bonds in the national market or in a national market are registered bonds. As I mentioned before, the legal and regulatory requirements are a function of which market the bonds are trading in. You should also recognize that bonds in different markets will have different characteristics. They might have different coupon payments. In some markets, coupons might be paid every 6 months. In other markets, coupons might be paid every year. There might be slight differences in how interest is calculated. There will obviously be differences in the currency denomination of the bonds and so on. Let's look at example 3. An example of a domestic bond is a bond issued by, and again I'll just refresh your memory here. So we said we have the national bond market, and within the national bond market we have domestic bonds and foreign bonds. I gave the example of Ford Motor Company in the United States. Let's look at these remarks. LG Group from South Korea, denominated in British pounds and sold in the UK. This would actually be a foreign bond in the UK bond market. So that's not the right answer. UK Debt Management Office, denominated in pounds, sold in the UK. So this looks like a good answer. Walmart from the United States, denominated in dollars, sold in various countries in North America, Europe, etc. This looks like a euro bond denominated in dollars. Not the right answer. So B is the best answer. A bond issued by Sony in Japan, denominated in US dollars but not registered with the SEC, and sold to an institutional investor in the Middle East. So SEC is the regulatory authority in the United States. Since these bonds are not registered with the SEC, they do not look like national bonds. So the best answer seems to be A. Global bond and foreign bond sound right, but global bond is wrong because that's not the correct term. The correct term is Eurobond. Foreign bond again seems right, but remember, a foreign bond falls under the national bond market, so it would be regulated by a authority in that country or in that nation. As you can see from these two questions, the distinction between a foreign bond and a euro bond is important and quite testable. Next we come to tax considerations. Simplistically speaking, you get a return in two ways when you invest in a bond. One is the income that you get from the coupon payments, and the other is capital gain. Obviously, you can invest the income and get reinvestment income, but that is outside the scope of this discussion. In terms of taxes, your coupon income is taxed and the capital gain is taxed. The income portion of a bond investment is generally taxed at the ordinary income tax rate. In other words, if you are a bond investor and you are in the 35% income tax bracket, then your bond income will be taxed at 35%. Capital gain will be taxed separately. What is capital gain? If you buy a bond for 900 at a discount and you later sell the bond for 1000, this is a capital gain. So the gain of 100 is capital gain income which needs to be taxed. In many countries, the tax rate is different depending on whether this was a long-term return or a short-term return. Generally, short-term is defined as less than 1 year and long-term is greater than 1 year. So in many countries, those rates are different. In some countries, the prorated portion of discount may be included in interest income. What this means is that if you buy a bond for 900 and let's say this is a 3-year bond, a 3-year zero coupon bond or a pure discount bond, then your capital gain is coming after 3 years. What the tax authority of a given country might say is that we know that you are going to get a gain of 100 over 3 years. So let's break this into 3 parts and tax you every year based on a prorated portion of the 100. That way the investor does not have to pay the entire tax amount at the end. Here is an example that I want you to read, and this is related to what we have just been talking about. This example is based on Exhibit 3 in the curriculum. I hope you found this fairly straightforward, but here is a quick rendition of what you read. We have a hypothetical country, and there we have two companies, A and B. Company A issues a bond at par value, and this bond pays a coupon rate of 10% every year. Now, an investor will pay tax based on this coupon income of 10%. So every year the investor gets 100 and pays income tax on that coupon payment. Given that the investor buys the bond at par, which is 1000, and then ultimately he gets 1000 back at the end of the bond's life, 20 years later, there is no capital gain. Bond B is a zero coupon bond where the investor buys the bond for 148.64 and 20 years later the investor gets back 1000. No cash flows in between. So what is happening here is we find the difference between these two numbers, which is 851.36. This is spread over 20 years or prorated, and then tax needs to be paid based on the prorated amount each year. This allows investors in company B's bonds to increase their cost basis in the bonds so that at maturity they face no capital gain or loss. The idea is straightforward. Since taxes are being paid every year, effectively we are paying income tax. Therefore, at the end, we don't need to pay capital gain tax. Let's look at example 4 now. The coupon payment is most likely to be taxed as ordinary income. We've talked about that. Assume that a company issues bonds in the hypothetical country of Zinland. That's the country we just talked about. Original issue discount tax provision. So there is an original issue discount tax provision in the tax code. This original issue discount tax provision is exactly what we had with company B in the previous example, where we calculate the gain. For this question, the gain is 200 because the bond initially sells for 800 and ultimately the investor gets back 1000. So the gain is 200. This 200 is prorated or spread across 10 years. And then income tax is paid based on the prorated amount. So what is most likely true here? An investor has to include 20 in his taxable income every year for 10 years and has to declare a capital gain at maturity. This is not true. If we are declaring income every year, which is the prorated amount, 200 divided by 10, which is 20, then we don't have a capital gain at the end. Include 20 in his taxable income every year for 10 years and do not declare capital gain at maturity. This looks correct. Does not have to include anything in his taxable income. That's not true because with this provision, we do need to show income every year. So the best answer is B.